Silver just went through 3 days of chaos that most people will only see once in a lifetime. One moment it's sprinting like it's on fire. The next moment it's getting yanked backward like a dog on a leash. We saw violent volume, historic swings, and price slam into levels that used to sound like science fiction. Here's what matters right now. Silver climbed into the 70s after tagging the 80s, and in the same breath it started acting like it wants to rip higher and punish late buyers at the exact same time. That's not a normal market. That's a pressure cooker with the lid rattling. And that's the question we have to answer today. Are we watching an intermediate blow-off that cools down first? Or are we watching the start of the final vertical move, where charts stop behaving and the tape turns into a slot machine? Now watch this, because the crowd is already getting hypnotized by one number. Is silver crashing to 50? And I'm going to tell you the uncomfortable truth. A drop to 50 would feel like a disaster, but in this cycle, 50 is not a joke anymore, it's a floor. A concrete slab. A level so thick it would take a wrecking ball to break. At the same time, we have to hold the other possibility in our head. This market can still make a run that leaves people speechless. I'm not talking about a cute little bounce. I'm talking about the kind of move where 100 becomes a waypoint, not a destination. Where 150 gets whispered, then printed. So we're going to do this the right way. Facts first, strategy always. This is educational, we manage risk. Let's start with the psychological trap. 3 months ago, 50 was the dream target. People circled it like it was Mount Everest. Now, after hitting the 80s, a 40% pullback just to revisit 50 is totally on the table. That tells you how far the rubber band has stretched. A stretched rubber band doesn't politely return to normal, it snaps. And the snap can go in either direction. This is why the next move matters more than the last move. The last move got the headlines. The next move decides who gets wrecked. There's a historical rhyme here, and it's not perfect, but it's useful. In the 1970s silver bull market, there was a moment where silver ran hard, then slammed into an ugly consolidation, then later exploded into the type of peak that turned into legend. The big question is which chapter we're in right now. If we're in the intermediate blow-off chapter, then what we just saw is a hot run, an exhaustion candle, then a grind that shakes out weak hands before the real fireworks. If we're in the final vertical chapter, then this is the launch sequence and the countdown is already at single digits. Most people want a single answer. The market doesn't give certainty, it gives probabilities. So we build if-then statements, not fantasies. Here's the first if-then that can punch you in the face. If the next macro shock is deflationary, panic selling, forced liquidations, margin calls, then the initial move can drag silver down with everything else. Silver doesn't get a free pass. In a liquidation, even good assets get thrown out the window. But here's the twist. In that scenario, the next move is not about the sell-off. It's about the response. If that panic hits, the response from policymakers becomes the fuel. That response can look like emergency liquidity, debt monetization, stimulus, whatever label they slap on it. Call it a fire hose. And historically, that kind of fire hose doesn't just lift silver, it turns it into a rocket. So the bearish case is weird. It doesn't stay bearish. It starts bearish, then flips bullish harder than most people can emotionally handle. Now ask yourself this. If everyone is already screaming that the currency is doomed, what's the one thing that can still surprise the room? A currency rally, a squeeze, a wait. How is the dollar going up right now? Kind of rally. When almost everyone is leaning one way, the market loves to kick the chair out from under them. On a long-term chart, the currency index has been riding a channel for years. Picture a river between two banks. Price has been bouncing inside that riverbed. Right now, it's pressing the lower bank. That lower bank is either going to hold and bounce, or it's going to crack and spill into a new regime. If that support holds, even temporarily, we can get a surprise rally that nobody is positioned for. And that rally can line up with a deflationary impulse. That combo is the classic silver gets hit first cocktail. Does that mean silver is doomed? No, it means we might get a brutal shakeout that feels like betrayal. The market's job is to make the most people uncomfortable at the worst possible time. Now here's where we tighten the lens. The chart just printed a candle that should make you sit up straight. A massive red day. A trading range so wide it looked fake. Huge volume. Up, then slammed down, engulfing the prior day's action. Technical people call it an outside reversal day. You don't have to worship chart patterns to respect what it does to psychology. It gives a lot of traders permission to sell into strength. It becomes a magnet for fear, so we can't ignore it. We don't get to pretend it didn't happen. That monster candle has two borders, the low and the high. Think of it like the walls of an arena. If price breaks below the low, it invites follow-through selling. If price breaks above the high, it can invalidate the bearish signal and ignite a chase. So we build conditions, not predictions. If price loses that low with conviction, we treat it as increased probability of a pullback toward deeper support. If price reclaims the high, we treat it as increased probability that the market is not done and the next leg is starting. And yes, deeper support is the word everyone is afraid of. 50? Let's talk about 50 like adults. 50 is not a random number. It's a battlefield. It's where prior breakout energy lives. It's where buyers who missed the first run get a second chance. It's where the market can test the crowd's faith. Could silver wick below 50 for a moment? Possible. Markets love to stab below support just to harvest stop losses. But a sustained collapse far below 50 would require a kind of damage that doesn't show up casually. That's why 50 behaves like a floor. Now don't fall into the opposite trap. Just because 50 is a floor doesn't mean the market will politely walk there. It can turn around at 65. It can bounce at 70. It can gap higher from here and never look back. That's the cruelty of the tape. So we do the only thing that works. We define what we're watching, and we decide ahead of time what we do if it happens. And while everyone is obsessing over silver, we also have to watch its quieter sibling, gold. Gold is the calmer vehicle in the same storm. When silver throws a tantrum, gold tends to move like a heavyweight boxer, slower, more controlled, still dangerous. If the metals complex gets hit, gold can fall too, but it often falls less. So one risk-managed move is a swap, not a full exit, not panic. A swap that reduces volatility without abandoning the theme. If silver has massively outperformed and the gold-silver ratio has compressed, swapping a slice of silver back into gold can be a way to stay in the game while sleeping at night. This is the part where the ego fights you. The ego wants the highest return. The ego wants to brag. The market punishes ego. We're not gambling. We're measuring. Here's a simple framework. Decide what percentage of your net worth you want exposed to this. If the move pushes you way above your number, you trim into strength to bring it back to target. That's not being bearish. That's respecting risk. Because selling at a peak is emotionally hard. The loudest bullish headlines show up near the top. That's when your brain starts telling you you're a genius and you should never sell. That's when you're most vulnerable. So we use ratios as an anchor. The gold-silver ratio is one of the cleanest. And when it gets extreme in one direction, it hints at mean reversion. When that ratio compresses fast, rebalancing can protect you without killing your upside. Now, the part that makes this story viral, the upside case. Because, yes, it exists. There's precedent for silver being extremely overbought, then still tripling anyway. An overbought signal doesn't say it must fall. It says it's stretched. A stretched market can correct, or it can enter a blow-off where momentum becomes its own fuel. In prior manias, there were moments where the chart screamed too far, then price went, hold my drink, and doubled again. That's why we don't short a raging bull just because it looks expensive. So what does an extreme upside look like? It looks like a measured move where prior breakout levels get multiplied in a way that makes your spreadsheet look broken. It looks like 100 happening faster than most people think is possible. Am I promising that? No. What I'm saying is the distribution of outcomes includes a fat tail, and fat tails are why risk management matters. And there are ways to frame that upside without turning into a fortune teller. One pattern people watch is the cup and handle structure. If you take the cup depth and project it, you can land in the neighborhood of the mid-90s. If you take the handle and project it, you can land in the high 80s. The important part isn't the exact target. The important part is the message. The chart still has room to run even after the violence. And then there's the wilder historical echo. In late cycle manias, you can see an overbought condition, a scary red month, and then a 3-month ramp that triples anyway. If you apply that kind of manias can do irrational math lens to a breakout zone, you end up staring at numbers that feel offensive to say out loud. 150, 160, maybe more. Not a guarantee. A reminder that tails exist. So ask yourself this. If we're wrong, where will it show first? Will it show in price failing to reclaim that monster candle high? Will it show in the currency ripping higher and smashing metals? Or will it show in miners suddenly rolling over while spot still looks strong? This is how we stay credible. We separate fact from interpretation. Fact? We just printed an extreme reversal style candle with range. Interpretation? That increases the odds of consolidation or pullback unless the high gets reclaimed. Fact? The 50 mid-50s zone is heavy support from a breakout. Interpretation? That zone is a logical battlefield where the market can test conviction. Now, what do we do with that in real life? We don't need a perfect plan. We need a survival plan. If you're sophisticated, there are tools. You can hedge with puts. You can sell covered calls into euphoria. You can use trailing stops if you accept the risk of getting wicked out. If you're not into derivatives, you can do the cleanest thing. Trim into strength, add on fear, and keep your position size at a level where you don't make stupid decisions. Because here's the mistake most people make. They treat volatility like entertainment. Then volatility turns into a tax bill. We're not here for thrills. We're here for outcomes. And it's not just silver moving. Platinum has been acting like a coiled spring that finally snapped. Years of boredom, then a sudden rip that embarrassed anyone who ignored it. That kind of move creates opportunity and danger at the same time. After a snap, the spring can recoil. So we watch prior breakout levels, we watch rising moving averages, and we refuse to chase vertical candles just because our emotions are late. Now we pivot to the quiet sector that can suddenly steal the spotlight. The miners. Normally, when silver gets hit, miners get hit harder. They're supposed to be leveraged. They're supposed to be the roller coaster version of the metal. But lately, we've seen moments where silver drops hard and miners barely flinch. That's not normal. That's the market whispering that miners may be undervalued relative to the metal. Undervalued doesn't mean immune. In a true risk-off panic, everything can get sold. But relative undervaluation can mean miners fall less on dips and have more room to run on rallies. There's another layer, the ratio of junior miners to the spot price. In prior cycles, that ratio expanded dramatically during peaks. Today, it's still depressed compared to those historical extremes. That gap is potential energy. If that ratio starts expanding again, we can see a catch-up move that shocks people who only watch spot. So here's the posture that survives both worlds. We hold two truths at once. A pullback toward 50 is plausible, and we have to be mentally prepared for it without panicking. The upside tail is real too, and a melt-up can happen even when indicators scream overbought. All in thinking is a trap. If we go all in on the crash narrative, we get left behind if silver rips. If we go all in on the moon narrative, we get wrecked if silver shakes out. So we keep exposure, but we manage size. We use swaps to reduce volatility when ratios get extreme. We keep dry powder if we want the ability to buy fear. And we define the lines in the sand that change the probabilities. Now answer this honestly. If price drops hard, will you see it as betrayal or as opportunity? Because that one mindset difference decides who wins. And here's another question that should bother you. If silver is up massively, why do you still feel anxious? Because deep down, you know volatility is a tax. It charges your nervous system. That's why the game is not just price, it's behavior. The market will try to induce motion sickness. Huge up days, huge down days, headlines that scream, new money rushing in from other speculative corners looking for the next rocket, weak hands buying late, then selling lower. The churn is how big players harvest liquidity. Our edge is refusing to play that emotional game. We respect the tape, but we don't worship it. We watch the key levels, but we don't let them own us. We don't need to predict the exact path. We need to stay alive through the path. So here's the real setup. If the currency surprises with a rally, and if we get a deflationary impulse, silver can get dragged down toward that 50 mid-50s gravity zone. If that happens, we watch for exhaustion. We watch for the moment where fear peaks and liquidity dries up. If silver instead reclaims the highs around that monster reversal candle and pushes above them, the bearish signal gets invalidated and the chase can begin again. That's when price stops asking permission. Either way, volatility is not going away. It's escalating. And that means your plan can't be hope. Your plan has to be simple enough to execute when your hands are shaking. Decide your target allocation. Decide your rebalance triggers. Decide what you do if silver tags 50. Decide what you do if silver tags 100. Decide it now while your brain is calm. Because when the tape is screaming, it's too late to think. So drop this in the comments. If silver dips toward 50, are we buying that fear or are we waiting for confirmation? And if silver rips toward new highs, what's the first signal you'll watch that tells you the move is turning into a blow-off? If you want more breakdowns like this with zero fluff, hit subscribe. Keep your eyes on that monster candle range, keep your eyes on the currency support, and keep your ego out of the trade. Because the next headline is going to try to trick you. The chart is going to try to shake you. And if we're right, the market is about to do what it always does at the most important moments. It's about to move so fast that only the prepared can keep up.